Welcome to Market Movers. I'm Jim Iuorio, and we're a week away from what I think is a pretty historic FOMC meeting. The consensus is that they're going to tighten, but the statement's obviously going to be the key. The CME FedWatch tool has it as an 80% chance of a quarter-point tightening. We're looking at using CME Gold, GC, and CME 10-year ZN to either hedge risk or create additional trade opportunities. Joining me is Chief Investment Officer of Kingsway Asset Management, Scott Martin.
Hi, Jim.
Okay, so it was not that long ago where the CME FedWatch tool suggested 4 tightenings in 2019. That has moved relatively quickly to now it suggests between 1 and 2. Do you think that's appropriate?
Memories, Jim, of a hawkish Fed that was going to get rates, I don't know, normal, you know? Man, how far have we come? How far has that pendulum swung, Jim? There's even a chance next year we don't get any, and it's very small, but there is that chance out there. So, look, it just to me tells you that things have probably gone too far to that one side where all of a sudden the Fed is now going to come in and be appropriately, I guess, or inappropriately dovish.
Does the flatness of the yield curve trouble you?
Trouble me. A lot of things trouble me, Jim, thankfully, I guess, or not thankfully. But I'll tell you what's interesting about it. The flatness doesn't bother me from the degree as we've seen the Fed kind of normalize rates in the past. Yield curves do go flat at times.
Sure.
It's just how long they stay here and what does the Fed do going forward is going to depend on what the Fed.
Sure. Just to interject, I think the predictive power of the yield curve has lessened with central bank manipulation over the last 10 years. I'm not saying there's not a recession on the horizon. I'm just saying I don't listen to the
And
Fed.
I think market volatility factors in there too, because the market could flatten the curve and be completely wrong.
No doubt. Now, before we dive into our trade discussion, I'd like to point out, with all market movers, it's important to view these as examples that allow you to see different ways to use futures and options products to either manage risk or create additional opportunities, not as recommendations or advice. Prices and movements will vary. Scott.
Yeah, so we're talking about a couple really unique asset classes today, I believe, because of all the volatility we've seen in ES. It's a nice kind of refresher course, let's say, to talk about things like, I think you're going to talk about ZN. I'm going to talk about GC today because I believe GC has some nice long-term benefits to it. But short-term, Jim, given the recent volatility in some of the other asset classes that are out there that we talked about on the show, I believe GC is probably hitting some near-term resistance because of its nice recent
Is that
performance.
mostly your thinking because if rates are going higher, then the cost of holding gold is lower?
More than I believe that just market volatility in general is going to calm down, and GC's been a shelter from the storm, basically.
Okay.
So specifically, Jim, looking and finally getting to the example here, I'm looking at buying the week 4 Ds, 1250, 1225 put spread. It'll cost you about 7 ticks to put on, so about $700, and make $1,800 if it fills out. Expires December 28th and has the underlying at about 1247. And just recent, basically, volatility has pushed GC up quite a bit. If you look at the charts, it kind of bumped up around that 1250 level. Therefore, I think market volatility is going to calm down. Maybe the appetite for GC is going to calm down as well, and that's why we want to put on the put spread.
I like this trade too, because I actually think long end rates are going up. And something that I alluded to before was that gold becomes more expensive to hold if there's other opportunities out there for you. That's why I'm looking at the 10-year. I'm looking at buying the week 4 Ds, the 119 and 3/4, 119 and a quarter put spread. Now those strikes are actually 119 spot 24, 119 spot 08. They call them 3/4 and a quarter for 6 ticks. It risks $93 to make a potential 407. Expires the same day, December 28th, and has March underlying, which is about 120.11. Thoughts? You think long-term rates are going up?
I do, and I believe that just, again, talking about this market volatility, we've seen the ZN behave as we have, right? I mean, It's rallied nice and hard. So to me, looking at some put spread or some protection here is a nice way to kind of at least have some retracement here.
Okay, the last question, and this is important now. The CME FedWatch tool says 80% chance in December. This is a Fed that wants to lead the market to what they believe. So if we're saying there's an 80% chance, doesn't that really mean there's a 100% chance, or would they really pull the rug out from under the market?
Well, let's hope they don't, but it begs the question is,
right?
Who's driving the bus here? I mean, and that's really the dangerous zone I think we're in with especially all the volatility that's out there is, who's kind of wagging the dog here? Is the market leading the Fed? Is the Fed leading the market? Once they get back on the right path or the same path, that's when I believe you're going to see volatility start to calm down and be more normal.
Understood. Thanks for joining us on Market Movers. I'm Jim Iuorio, where we're helping to make you a better trader.